Hey everyone, thanks for joining us. I'm Rob Simone. I'm the REIT sector head here at Hedgeye. We're kind of doing something quasi on the fly. A very topical issue came up over the last 2 weeks involving the B-REIT and the S-REIT and kind of the trade-offs and pluses and minuses of non-traded or private REITs versus public REITs in general. So I thought it would be interesting and fun to invite two friends. One of which I've known for a long time. His name is David Auerbach, both of Armada ETFs, by the way. And then another gentleman who I just recently met, Phil Back, who is the CEO of Armada and has been very vocal on Twitter recently with a couple of very interesting threads about the B-REIT specifically. So I thought it might be useful for everyone to have a discussion. And so, gentlemen, welcome.
Thanks, Rob. Great to be here.
Of course. So why don't you guys go one at a time and introduce yourselves? I kind of gave the intro, but let everyone know who you are and what Armada does. Or Phil, you go first.
My name is Phil Bach. Yeah. Sure, I'm the CEO of Armada ETFs. Background in ETFs, I've done a bunch of things, another startup in ETFs and some other capital markets and product work in ETFs. We manage the House ETF, HAUS, which gives access to residential REITs, publicly traded residential REITs. And that's really how we got into starting to look at this. We were trying to figure out what's the best way to structure this fund. Do we want private REITs? Should we be offering a private REIT fund? Do we like the publics? And we saw first the valuation discrepancies and started to do more and more research, which led us down this road. But thanks for having us on. It's great to be here.
Of course. How about you, David?
My name's Dave Auerbach. I'm the managing director of Armada ETFs. I've been in the REIT industry for almost 25 years, serving as an institutional trader, did a lot of corporate access, analyst, but I joined Armada as the managing director to help build out, as Phil talked about, House, the residential REIT income fund. I put together a REIT management team to help us run this REIT ETF, as Phil talked about. Armada is focused on 25 publicly traded residential REITs comprised of multifamily, single-family rentals, senior housing, and manufactured housing. Student housing, different sector. But it plays very relevant into the B-REIT, S-REIT conversation. We're really excited to get into this because there's some really great parallels and takeaways from all of this.
Yeah, definitely. So obviously, for folks who haven't been following along day to day, the B-REIT situation may kind of seem like it came out of nowhere, but in reality, as you guys know, it's actually kind of been percolating for a while. And this isn't the first kind of go around this industry, and I guess you could say the illiquid end market closed-end industry has had going back years. So Phil, you kind of got the conversation started on many levels. Like I personally have been talking with clients about what we've seen for a couple months, but obviously wasn't as out in front and center as you were. So maybe take us back to the beginning and walk us through exactly what's happened here and what maybe a step further, what folks should be on the lookout going forward.
Yeah, and it's funny. You talked about how this has been going on for a while. It's been discussed for a while, and that's right. It's I kind of put it in one of my posts. I talked about Taleb's turkey, right? The well-being of a turkey charted over 1,001 days, and for 1,000 days it's well fed and everyone's happy, and then all of a sudden, boom, Thanksgiving comes and it's the end of the turkey. It's kind of a similar thing where a lot of people saw this coming. I don't think we're the only ones. A lot of people saw the divergence between the valuations of public and private REITs. A lot of people saw the smoothing issues of the the returns on the private REITs, obviously the issues with the appraisal-based NAVs. I think these things didn't really matter, right? As long as the inflows were so great and so many people were buying this thing, and there was a market where Blackstone could continue to buy up properties and they didn't have to meet any liquidity demands, and everything is up and great, and markets were great and rates were low. There's really no problem. Then all of a sudden we wake up one day and actually there is a problem. Right? And there is not enough liquidity available here. And all of a sudden they have to sell properties and have to sell them at, fantasy valuations, and we can get into that. Mm-hmm. But all of a sudden now people are starting to realize, hey, maybe there's a bigger risk here than we thought. Risk comes quick, right? It comes quick. And things that were kind of theoreticals a few months ago are now very, very real possibilities.
Yeah, our founder, Keith McCullough, likes to say, risk happens like kind of gradually and then all at once. And clearly that, for better or for worse, that's kind of what's happening here. But maybe take a step back, like how, maybe explain for folks like mechanically how these vehicles work. And exactly what the issue is underneath the surface between like net redemptions vis-a-vis asset value. Like what exactly is happening underneath the surface that caused B-REIT, and by the way, not just B-REIT, S-REIT as well, to gate their funds. Yeah.
Well, when you're talking about publicly traded REITs, right? Of course, they trade on the exchange and there's price discovery there. And you can say, as Blackstone does, you can say that publicly traded REITs, well, the public markets exacerbate liquidity, they jump around. There's too much volatility. Okay, that could be true. Maybe not. If that were the case, you could say that there's also opportunities to take advantage of the volatility day to day. But let's say that's the case. Let's contrast it to what we see in the non-traded REIT markets, where the valuations are determined by appraisals, right? And the appraisals happen periodically over time. So every quarter you get your statement from Blackstone that tells you, well, these things are worth X. Those numbers are, they're legitimate. There are smart people putting them together and they're using their estimates. But those appraisals happen on a periodic basis. And then you get your valuation, your NAV, that's set based on those appraisals. So, think about it as a lag that happens in the valuation of these properties. And it doesn't really matter when things are slow and steady, but when there's a turn in the market, when there's a turn in the real estate markets or in the economy like we had, it takes a while for those appraisal-based valuations to catch up. So if you chart on one side, you chart the public REITs versus the non-traded REITs, and you chart the performance of the two, you'll see divergences and convergences over time, right? They trade away, one gets away from the other, and then they come together. The divergence between the two has opened up to the widest it's ever been, to an absurd, laughably level right now that there's no way it can be realized in the actual real world. And I don't think that's very much a secret. I think a lot of people are aware of that. And as long as there's enough liquidity, that's great. That's great news. So I've got, my fund is at an inflated NAV. That's great. If I need to get out, I can get out at a great level. However, all of a sudden we start to see redemption requests pick up. And all of a sudden now Blackstone has to, create more liquidity, which means that they're going to have to sell properties on the, in the real world. And then the NAVs can no longer be reflective of the fantasy valuations or of these appraisals or these lagging old appraisals. It's going to be, what can they get in the market? What can they get today if they have to sell? Well, who are they selling to, right? The biggest buyer in this market was Blackstone. You'd say Starwood was right there with them, right? These private refunds were the market. They were the buyers in this market. Not only are they no longer buyers, right? They are now sellers, forced sellers that have to go out and find liquidity in a market that's being described as a frozen market. So it's not a good time to be creating liquidity. Now, Blackstone has lines of credit and they have CMBS. They have other ways of getting liquidity. And I think what they've been out with, the messaging that they've been out with is, look, this is really no big deal. We've outlined this in the prospectus. This is a temporary thing. We just need to get a little bit of liquidity, and then we can ungate the redemptions and everything is back in line. And that might be true. That might be possible if they can pull that off. However, the fact that they've gated redemptions now creates a psychological, it creates a reason why you don't want to be last in queue, right? Yep. If I need liquidity a year from now, I might want to put in my request now just in case, right? Because if the line gets longer and longer, it becomes a self-fulfilling prophecy. You get a run on the bank. They have to sell more and more properties with less and less buyers and worse valuations. So there is a huge risk here that what they've kicked off without saying, hey, we're just going to gate these things a little bit. We've got all these redemption requests from Asia. We're just going to, manage that, and then we'll be back to normal. I think they've underestimated the social anxiety that they've caused by doing so, and how that's affected, their other investors. And again, the possibility of a bank run here is very real. And if there is, the price, the NAV on this thing is going to come crashing down. There's no way around it. It's going to come crashing down. We can get into the details on how and why.
Yeah, definitely. And by the way, just a quick aside, my guys in the studio just asked everyone who's following along to refresh the page, refresh the viewer, so as to access the Q&A box for when we get to Q&A at the end of this presentation. But Phil, you hit on something interesting there, and Keith and I had a back and forth on our what we call the call. It's like supposed to be representative of a morning research call. We do it every morning with our clients. And Keith posed the question to me, like, what happened here, or what is Blackstone's kind of rationale for doing this? And and I said similar to what you said, and I would love for you to chime in here and tell me if I'm wrong or if I'm missing anything. But I basically said, like, well, regardless of whether or not increased redemptions from Asia is true or not, like, I kind of don't care because it doesn't matter, right? Like, it's the kind of thing where, at least in my opinion, once you have a gating event, it severely limits the options available to the remaining LPs. And maybe comment on that. And David, you chime in too if you'd like. But comment on that. But then also, like, what other options do the investors have? And by the way, who are they? Right. So, like, this is an interesting question as well, and it speaks to the space that we operate in addition to non-traded REITs. Like, who are the folks that are on the other side of the gate now that are, like, worried about this becoming existential to them?
Yeah, well, let me take kind of I'll hit both of those, and then I want to hear from David. But
yeah,
in terms of the best case for BlackRock, I think this fund has been remarkably
Blackstone. Yeah,
this fund has been this fund has been remarkably successful, and their ability to gather inflows in this thing has been phenomenal. And I think that may have created a little bit of hubris where they think they're out there and they can create those inflows. Those inflows offset the redemption requests. Mm-hmm. And then they're out. They don't even have to sell property. They don't have to mark down any NAVs. They're out scot-free. And they've been out talking about the historical performance of this fund and the historical volatility of the fund, which to me is very much a mirage. I mean, the smoothing issues on this thing are outrageous, as everyone knows.
Yep.
And I think, they think that they can, create that demand and that solves their problem. If they can do that, it does solve their problem. I don't think they can, not in this environment, not with people being spooked now on the gating of the fund. And in terms of who are the customers, and this is a retail product. This is huge in the wirehouses, huge with financial advisors. And the sad thing about this is, the more and more that people are using portfolio optimizers and outsourced asset management, mm-hmm. the more people are using, these risk metrics. We're going to risk qualify every investor and then, tilt our allocation model based on that. Well, because of the smoothing issues and because in a zero rate environment, this fund has been such a strong performer with like absolutely no drawdowns. Well, this fund has been classified by the optimizers as the lowest of low risk. And that means that the investors in this fund are, the proverbial widows and orphans, the least risk, the most risk averse investors that we have, mm-hmm. which is so sad because, they're going to be hit with a drawdown here, a very significant drawdown, and they're the least willing to take that. This fund has been sold to people who it's not appropriate for because mm-hmm. it's been sold as a low risk investment, not necessarily marketed as such, but sold by the algos and by the portfolio optimizers, when in fact, on a forward-looking basis, we think there's tremendous downside risk here in mm-hmm. the short term.
Mm-hmm. Dave, do you have anything to add to that, or do you think, or you might be on mute, David?
For the ultra high net worth investor that's got like $100 million in the bank, that's got $5 million tied up in it, they're not losing sleep necessary. For the guy that's got $2 million in the bank with $500,000 locked up into it, they're the ones that are sweating bullets right now. And as the company has already stated, with them basically gating it, there's guys that may not be able to get out through 23 into 24, potentially into 25, mm-hmm. because the real question is now, we knew what the line looked like in the middle of December when Blackstone and Starwood put out their announcements. But the question is, how much has the line grown incrementally over the past week? Are we talking another $5 billion sitting in the queue? Is there $10 billion sitting in the queue? What happens if they hit their quarterly number, the 5% number, on January 1st? Yep. What do you do? Yep. And I think nobody knows the answer to these questions, but clearly, again, this is just, I think, our internal opinion. And you know what they say about people who assume? You can go ahead and assume that 2% are already hit and they're on January 1, that they're going to already have that 2% number when the day the market opens in January.
Yeah. So first of all, that's really helpful and useful. I guess where I settle out on thinking about this is, in many respects, this needs to be an issue couched around disclosure and fair disclosure. And so I guess my opinion, and again, this is just my opinion, where this crosses over into like really potentially insidious is when you have people getting up on stage or in an interview that should know better saying, hey, like, our investors are up 9, 11%, whatever the number may be, halfway through the year, when everyone else is losing money hand over fist in the markets. Like that to me, in my opinion, crosses a line because like clearly it's based upon dated marks. It's not being marked to market. There's no like real-time liquidity. I've been vocal about this on the call. Like I personally have an issue on that. But I guess like from where you guys sit, first of all, what are the advisors at the end of the distribution pipeline saying to you guys, to the extent you've spoken with them at all? Like what are they hearing? And B, do you feel like, in your view, the people in may have not been the appropriate investors for the structure, but do you think the disclosure was there, in your opinion, up front? Or what's your kind of take of that?
So I was going to take a stab at this. First of all, the company will tell you that they do fairly disclose it. You may have to go finding the data, but they do post in their 100 pages of prospectus documents when you sign the selling arrangement or the selling agreement. They do state it in the document. So from the client's perspective, they will tell you that they have CYA. That being said, it is not in bold print on the front page of their website 225, and here's what you're walking into. Number two, from the advisors and folks that we've talked to, I got to be honest, we've heard of a variety of answers that cross the spectrum. Some folks view it as a non-event. Some folks are talking about it internally on a team-by-team basis and, taking the conversations from their customers or being proactive. And some folks are, viewing this as a frankly, as a red flag. But you have to understand that a lot of these platforms, these big wirehouse platforms, the Merrills, the Wellses, the UBSs, any of these advisor platforms, and Phil could provide some more color there. It's going to take a top down from the corporate office company mandate from the bosses to say no more, take all the money out, as opposed to like a Merrill office in Florida versus a Merrill office in Arizona. I think it's on a team by team basis, but I feel like a lot of them are being responsive to what their clients are saying. The problem is that with this hitting every single media outlet possible, from Twitter to the broadcast channels, through LinkedIn, through all the Wall Street publications, every single investor is seeing this news in some form or fashion. It's being hit at them 10 different ways every single day. And as Phil started out on this call, this is not going away. We're not just going to suddenly wake up on March 17th and they're going to flip a switch and everything is back to normal and there's no issues. Yep. This is dragging on for a considerable period of time.
Yeah, 100%. And I just want to add to that. One of the things that we've heard from a lot of investors is like this reverence for Blackstone. How smart. These are the smartest guys in the market. They're very good at this. They know what they're doing. There's been a lot of goodwill built up over the years from Blackstone and from the portfolio managers of this fund. And what I would tell people is they are truly brilliant. I'm sure they are, as was long-term capital management, right? As were many people that have blown up. The fact that they're very smart is not going to save them. It's not going to provide liquidity for them when they need it in a frozen real estate market to meet redemptions. And another thing that I think they need to think about is this is a very expensive fund. It is very expensive. We've got
that was going to be my next question, by the way, like understanding the incentives and like, because this is key, right? So go for it. Do your thing, because this is really important.
We've got selling fees, and they go back to the wirehouses, to the home offices. We've got a management fee of 125 basis points. We've got a performance fee of after a 5% hurdle of 12.5%. And we've estimated, there's a lot of assumptions depending on what share class and what the performance is in a given year. We've estimated about $2.5 billion a year being generated in total in fees from this fund. $2.5 billion with a B on this one fund. So there's a lot of money at stake. And it's a very expensive fund. And I think what investors need to think about is, what are you getting for that money? What's the premium that you're getting versus the public markets, right? You can buy VNQ for 12 basis points. We have a fund that we think is a little better. It's nowhere near as expensive as this, right? What are you getting to pay for the premium? The answer is you're getting high valuations and less liquidity, right? Much less liquidity. So you'd have to wonder, is now a good time to take chips off the table? You know, you made a good call. You were in this thing. It ran up while the Fed was accommodative. Is this the time before before it truly hits the fan to get out at a price that might not be attainable another few months from now?
Yeah.
Rob, I want to.
Oh, sorry. Go, Dave.
I just want to pick up on one point here, following on the fees, piggybacking on the fees. Let's say, I don't remember what the cap rate was on the American campus transaction off the top of my head, so please forgive me. Let's just assume it was a 5% cap or they bought American campus. But with the way that the fees are structured, the cost of the investor means that the investor actually wound up buying American campus at a 4 cap. And with property values moving the other way, and probably closer now to, let's say, a 6 and 6.5 handle based on where interest rates and current market has gone, how does an investor sitting on a 4% cap rate investment make money when the world's trading at a 6 handle right now?
Yeah.
That's the problem here. When Blackstone's telling you this is worth 4 and change, or a 4 and change, and the answer is no, it's not. The investor is not going to see green on that particular slice of their investment.
Yeah, and it's funny. Like, so just really quick, I have a specific follow-up question about the fees, but like we've had a big discussion here at Hedgeye about this new not cap rate, but cost of capital regime that we're entering into, and exactly like kind of what it means for returns and forward expectations, all of the above, and also it kind of fits with what we call a quad 4. Quad 4, we kind of model everything around a rate of change concept, and we're in the second of what we think is going to be 4 consecutive quad 4s, where really, you have it's a second derivative concept where the rate of change of GDP growth and inflation, while it still could be positive from an absolute perspective or absolute level, is rolling over and is declining on the second derivative. And it usually corresponds to when liquidity is being taken out of the market. And what you guys are describing is really a liquidity issue, right? So like when it's kind of like when the tide's coming out, you understand, like, colloquially, who's swimming naked, so to speak. And right now on the margin, investors, both large and small, are looking for sources of liquidity. They're not net contributors to like closed-end kind of a liquid funds like this. It's not a great setup. And I guess like one follow-up question or one issue, like Phil, I caught it this morning, but related to the fees, I think, correct me if I'm wrong, but I think you were trying to equate an AFFO multiple relative to.
Yeah, that's right.
Yeah, could you walk through it? Because I think that's a really interesting exercise, and it's something that like I do with my REITs to like normalize for overhead and for CapEx. I think that's what you were getting at. I just want to make sure I understand it fully. And for people at home,
I'm really glad you asked that question, because again, the important thing here is that's really a valuation question, right? So what do you how expensive is this fund? Not in terms of fees to Blackstone, but how expensive are are you buying in at if you're coming in? And I think AFFO is great, as a way to just kind of measure cash flow, right? And when you look at the way Blackstone is measuring their AFFO, they're adding back in their fees, their own performance fees and the management fees into the AFFO and counting that. I don't think that really, to me, doesn't really pass the smell test. I mean, if you take their AFFO as gospel and you go with that, then their valuations are incredibly overpriced. But if you normalize it and you take out the management fees to Blackstone from the AFFO and say, well, how cheap or expensive are these properties that you're buying into? It becomes comical. The AFFO is almost 400.
Yeah.
So it's pretty wild. And I think, again, marking the fund at a certain NAV over time and looking at the historical performance of a fund is different than understanding the value of the property that you're buying that is, that a share of the fund represents.
Yeah.
And people need to take that kind of second order due diligence and think about that. What are the properties I'm buying? What are the valuations that I'm buying at that? How does that compare to going out and buying the properties myself or buying them through public REITs? And if they did that analysis, I think they'd see that this is not a very good time to be invested in this fund.
Yeah.
Rob, just one more part to add on leveraging all your years as a REIT analyst. REITs are valued in 3 different ways, right? Implied cap rates, NAV, AFFO multiple. Any way you slice and dice it across all of these 3 different spectrums, it's just not feasible. Let's take it one by one. They're saying their cap rates are sub 4. Markets are trading at 5 and change right now. Mm-hmm. There's a disparity there. Phil just went to the AFFO multiple angle there. Massive disparity there. NAV analysis. Blackstone saying their stuff's trading at a 9% premium to NAV. Average REITs basically on a kind of comparable are trading around a 9-10% discount to NAV. So when 1 + 1 + 1 = 3, how is it all of these things are pointing to the sign that things are going against what Blackstone's doing, but they're telling you, no, those guys are wrong. We're just better operators. We know what we're doing.
Yeah.
And again, we're not discounting the properties. You have to understand, they own high quality properties. It's a high quality management team. We understand all of that. But if you basically try to replicate it using our publicly traded REITs, and you've really use VICI to cover gaming and use, Agree to cover net lease and some of this other stuff, you just can't get there. You just can't get there to their number on the public versus private. It's just not possible.
It's not possible. And you know what I would compare it to? It's kind of like the old externally managed REIT argument in the public markets, right? So like you can have the best assets, like the highest of high quality A assets, like let's take like ILPT, for example. I'm just going to throw that one out there, right? Fine portfolio, but when you stick an external management structure that's like bleeding fees to the the mothership or like the sponsor, and then you layer on obscene leverage, it's going to trade at a discount in the market. And if you don't take into account those structural factors over and above the real estate, you're going to come to the wrong conclusion potentially. But
you absolutely nailed it, because it applies that pretty much across the REIT spectrum for the publicly traded REITs.
Yes.
If they're externally advised, there's always a red. There's always a red flag with them that's tied with that association. No question about it. As a longtime REIT trader, working with a lot of your colleagues, everybody says the exact same thing, and they still say that to this point, to this day. To this day,
yeah. Okay, so by the way, guys, like this is actually incredible. We're getting like smashed with questions. So before I open it up, because I would love to give people as much time as possible to make it interactive with you. So where I'm really trying to focus my time as a public REIT analyst is to think and handicap about, and maybe you guys do too, running like a public REIT ETF, like what implications does this have potentially for the public markets? And I'll give away like kind of my thinking. I just look at B-REIT and where they allocated their capital, like lots of Sunbelt resi, right? So they bought BRG, they bought APTS, they obviously have a huge industrial portfolio. You mentioned ACC. Like the interesting question to me is what happens when, for better or for worse, a market where they were the largest, presence at the auction, effectively kind of for this chunkier stuff, like, I don't know, goes no bid. And what happens when, a lot of these, let's just talk about Sunbelt. I know you guys are in this business, but Sunbelt apartments like valued at a 5 cap. Like, well, okay, what happens when they're valued at a 6 when the bid ask widens? So I don't know. Like that's where my mind is. But how are you guys thinking about it in your fund?
I'll take a stab at it, and then Phil can clean me up here. I think based off the quality of the portfolio, we know, as Phil said, they were always the natural buyer. Now they're the natural seller. They're the ones sitting on the selling side of the table. But also in the same breath, we know most likely who those buyers are going to be. Chances are it's going to be the publicly traded REITs, their competitive peers. It's going to be sovereign wealth funds or sell-side bulge bracket firms, doing these big private mandates and stuff. And so I think on a city like, you mentioned Sunbelt apartments, so if there's a portfolio that comes up for sale in Dallas or, in Austin, there's going to be a natural pool of buyers there. If it's a property that's in Provo, Utah, you're right. What happens if it goes no bid and then it kind of goes on the market? I don't necessarily see the company doing fire sale type pricing unless it really becomes a really major going concern issue, and we're not implying that it is. But I don't see them really necessarily doing fire sale pricing. But I think from the public perspective, again, this emphasizes the why publicly traded REITs. We talk about that liquidity, getting in and out. We know where the markets are going. With these publicly traded guys, we could talk about your favorite company, Rob, Invitation Homes. They do a good job of, here's where we're buying at, here's the cap rate, here's our average going in price. They disclose that. We are not, whether it's on a press release, on a transaction that they did, on a quarterly earnings call, they give us that information versus the private REITs. You have to wait for them to tell you once a month what your NAV is worth. You have to wait for them to publish a quarterly report to tell you what the property is worth. And I think with the publicly traded guys, they're kind of guiding towards where the private market is going right now, as Phil keeps talking about that lag indicator here, that there's no question about it. The public assets have reset here from the start of this year. We already know that because the market has dictated that with the way the interest rates have moved. And I don't see that readjusting next year. I don't see this having a major reset. So this issue is going to carry into at this point, 23, well into 24.
Mm-hmm. Mm-hmm.
Yeah, it's amazing. It is a new liquidity regime. And, you don't want to be, you want to have liquidity when this thing turns. We all saw this coming. And I think, you look at certain markets, you look at crypto, you look at non-profitable tech, you look at some startups. There's a lot of people suddenly searching for liquidity that took it for granted over the last several years. You don't think about your low volatility private REIT fund as being, the desperate searchers of that liquidity. You think that they're going to be fine. And, because of the liquidity issues that they've had, because of the structure of the fund, they are, and it's very unfortunate. As long as we stay in this regime, it's going to be very difficult for them. And again, I agree with David. I don't think we're talking about a fire sale, but we are talking about a very significant drawdown from the NAVs that people are expecting. The NAVs that have been reported, a very significant drawdown that I don't know if all their investors are prepared for.
Yeah, that's interesting. And okay, so I want to go into questions, but I have one more for you guys. And just to be fair and objective, like everything has trade-offs, right? So what, to your guys' mind, if you lined up publicly traded REITs and then either, private or NTRs or non-traded REITs on the other side, like tick through the attributes, like what are the puts and takes for each of them? Just to like kind of give people a framework on how to like evaluate these two structures against each other.
Well, I mean, you're talking about a liquidity difference is the main thing, but I'd say now at this point in time, which may or may not be the case forever, but you're talking about a valuation difference, a very significant valuation difference where, you could say that the publicly traded REITs, you like or don't like their valuations or what your forward estimates are, that's up for discussion and that's a fair discussion. But on the non-traded REITs, you're looking at valuations that are just frankly not attainable in the real world, in the real market. And as more of these buyers become sellers or forced sellers because of redemptions and they need liquidity, there's going to be a true up between the two. There's going to be a true up between at least, if not in full, in most, between the private and the public REITs. We're talking about properties that have very similar characteristics. And there's no reason for a sustained 20, 30, 40% delta between the two.
Yep.
Rob, if you take your favorite REIT, let's just use the biggest one, like Simon, just hypothetically, use Simon Property Group.
Sure. You
got 25 analysts that are out there to tell you what Simon's NAV is, what their average cap rate is. Well, but what I'm getting is you can get a range. You can get a general range from 25 analysts of here's where we're at.
Yeah.
And if we adjust the cap rate by
of course, yeah.
If we adjust the cap rate by a tick, here's where that number goes. And if we lower it, here's where that number goes. But you have 25 guys to check that number off of, and the company will tell you, dude, you're right, you're wrong, that's great, good, no chance. Blackstone ain't going to tell you anything. Yeah. You don't have 25 guys covering Blackstone because there is nothing there to go through because we're doing this model ourselves and literally and we're talking first and everybody has a different number that they're coming up with. So, Blackstone isn't telling you, you've nailed our cap rate on apartments. Yeah, you're way off on our industrial. Nobody's giving that information versus the public guys that are more than happy to tell you what that number is.
Yep. Okay, so let me because honestly, this is great for you guys because I've actually never seen the question queue fill up this large. So I'm just going to pepper you with some. We'll make it interactive with folks. So the first one's from Mike. I actually think I know who this is, but Mike, is B-REIT really going to be a forced seller here? They have the ability to completely gate the fund. Or how do you?
Is that a better outcome? They have. That's a possibility, but I don't think anybody wants that.
Yeah. Well, let's say
they have a portfolio that they're marketing apparently of lower quality industrial stuff that they bought from PSB. They're probably going to sell American Campus, some of the lower quality assets of American Campus. Mm-hmm. Same with APTS, same with Blue Rock and all this stuff. So they have assets that they can monetize here based off of the cost. The question then becomes, what do you start doing? Because from historically, Rob, for all of our years, if you know what Blackstone's MO is, let's use Hilton, let's use La Quinta, let's use one of these previous transactions they've done. They buy out a company, it sits on the book for 2 years, they put a new coat of paint on the property, a new sign on the front door, and they turn around and they relist it back to the market, and they sell the same shit right back to the market all over again. And so they have to, some of the stuff, they have to sit there and hold it for 2 years. They can't just fire sale it necessarily. They can call and cherry pick some assets here and there, but I think we're not going to see them suddenly monetize a QTS next year just to raise $750 million, $1 billion to satisfy second quarter redemption requests.
Yeah. Well, let's say they did completely gate the fund. Maybe an interesting question is like what would be Blackstone's incentives to do that? Because like, you know, I went through this right out of college. It's kind of game over when you do that, right? Like, good luck ever raising money again. If you, I don't know, and that may or may not be true in this scenario.
I have a dumb answer. I mean, again, Phil can educate me here. If you gate the fund, that means you've capped how much is in there, which means you can keep collecting the fees on the amount of money that's in there. Versus if you let money go out the door, that's less money that you're able to collect on fees, right?
Yeah.
So if you're basically saying we're locked down, we're at $1 billion, great. That means we're raking in X% on fees on a rolling basis, and nobody else is getting out.
Yeah.
Phil?
Yeah. Okay. Well, all right. Let me keep going down because again, there are a lot of them. This is from Stuart. Excuse me. B-REIT has a massive gain on interest hedges. Is it normal for these private REITs to buy rate hedges? It was a great call. Doesn't that offset some of the pending markdowns?
Yeah, I have the number on this. I think it was 4.4% or so that they made last year on that.
I think that's right. 6%
from interest rate hedges, and that was a great trade. Again, you know, at the end of the day, if you're trying to get access to, to real estate, to tangible, if you like hard assets and you want access to, you know, what is generally a very stable asset class, you want to know that, you know, if they can make money on the fringes, they could probably lose it on the fringes too. But, you know, is that the bet that you're making as an investor in B-REIT? Is that the bet that you want to continue making? Or do you want to make that bet separately? Or, you know, if they can enhance the yield, that's great. At the end of the day, the core issue is the properties that they own, the valuations of those properties today, the valuations of those properties at the time that they're going to sell them, or at the time that you can get liquidity on the way out, or where the NAV is. And I think that, you know, the other stuff is, it's nice. Maybe that'll offset the fees, you know, or some of the fees, and that's certainly a good thing as long as it's working.
Yep. Okay, so here's a good one. And I actually don't. I should know the answer to this, but I don't know the answer to it. This is from Bob in Houston. How much leverage does B-REIT carry in the structure? AKA, how leverage are the assets? If these properties are bought at 3 and 4% cap rates with, like, you know, illustratively a 60% LTV, and, you know, from the time they were purchased, little or no increase in NOI, or maybe even NOI declines next year. New appraisals at 5 to 6% could wipe out the equity. So, like, how do we know, like, how much leverage is tucked in there? Phil or Dave, I'm not sure.
So yeah, we're working on a model actually. So we're working on some analysis. We don't have anything today on that.
Yeah.
We do have on that's kind of early stages. That's the next. We wanted to get through some of the stuff that I put out today, but we're going to be answering that over the next week.
Absolutely. Okay. All right. Yeah, we can follow up on that. I mean, that's a really good question too, because that would also like help explain the incentive set in a way. Okay, this is from Mike. Or actually, before that one. No, this is a good one. Actually, this is a good one from Mike. Hi, guys. I'm involved in a private REIT focused on industrial, mission-critical properties. Management seems to have done a good job over the last 5 years, consistent conservative growth of determined share value. So that would, again, for the people at home, that would be the stated NAV, not your distributions, and a 6% yield on top of it. Fully leased portfolio. What should I be asking them? Thanks.
I would be asking them about smoothing issues. When you talk about consistent conservative growth, that's exactly what B-REIT's provided, and it's a great thing. It's what we all want, right? But the question is that a function of, you know, the lags in the appraisal process, and the fact that they're setting the NAV slowly over time? If comparable instruments are being marked to market on a daily basis, you'd see a very different picture of volatility. This is something Cliff Assis has been calling it volatility laundering, where you've got a structural difference here, which is less beneficial to the end investor. I think transparency and liquidity are good things. So it's worse for the investor, but it's being turned around and marketed as a good thing because at the end result, you're showing much less volatility. If I take my daily trading account and only look at it once a quarter, it's going to look a lot better. If I use appraisals instead of mark to market, it's going to look yet better. So when we talk about consistent and conservative growth, that's a wonderful thing. It's what we all want. It's great. It's great in in private equity funds, in venture funds. It's great in non-traded REIT funds. But at the end of the day, comparing that to your publicly traded funds is really not an apples to apples comparison. At the end of the day, I think the most important thing is your time frame as an investor in these things. And I think, I can't speak to, the fund that this guy owns. I don't know what it is, but even as we talk about B-REIT and Blackstone, these are very high quality properties. These are properties that I personally would love to own for the long term. Our concern is not that, this is going to go to zero or these are garbage. That's not the case. The concern is that the valuations right now are not in line with reality and there's going to be a drawdown. And if there's an exacerbation of liquidity demands and redemption requests, it's only going to make that drawdown worse and worse and worse. And investors need to think about getting out in front of that, not being the last one in line on the way out.
I'll take a quick stab at this. If you look at like the industrial guys, everybody's done very well the past few years since industrial has been one of the darlings of the publicly traded REIT sector, right? So everybody did well as things were going up. Look at what's happened to Amazon, though, as Amazon started giving back some of their industrial space because they basically took down too much during COVID. What happened to those guys that had that exposure to Amazon? And the answer is they sold off because they felt that, who's going to turn around and lease 1 million square feet again? How are we going to fill this? How are we going to backfill this space? My takeaway here is that you see how people do when things are going up, but you really see how a good operator does when things are going down. And so as a result, I would be curious to see, to find out from that other sponsor what happened in the last cycle when things weren't going up as heady as they have been the past couple of years. What did the redemption queue look like for you guys back then? Are you guys getting the phone calls now that we're seeing down the street from some of these other guys? When we started these conversations last, couple of weeks ago, and it was just talking about B-REIT, I went out, I'm like, hey, if I'm Starwood, I'd go on offense, put this message out. Hey, this what's happening down the street isn't happening to us. Unfortunately, they were in that same position. And so now if I'm one of these other non-traded REITs, I'm not saying that everybody is going through the exact same issue that B-REIT, S-REIT is, but if I'm not having those issues, you got to go on offense and control that narrative saying, hey guys, we're fine. We're sound. We're not seeing redemptions. We could satisfy requests. We're A-okay. And I don't see people going out and doing that right now.
Okay, so maybe a couple more here. So this one from my buddy Marty. Which property types do you guys think Blackstone is most likely to sell to meet future redemption requests?
And I know which Marty that is as well. I'll say hi, Marty, from both Bill and I, too.
Yeah.
I would say right now they're going to probably go with where the strengths have been going. So I do see them selling some of the single-family rental stuff. I could see them selling some of the high-quality apartment. I could see them selling industrial, again, because that is where, the pricing is going. Data center doesn't seem right now as high as it was a couple of years ago. I don't think they're up on the QTS investment. Again, there's guys that would know better than I do when it comes to that. But again, as we look at the high-quality portfolio, I think they're going to focus, kind of on that where the puck is going and where can we get the most bang for our buck. And so again, they're high quality industrial, some of their Sunbelt assets, they know there will be a natural buyer sitting at the table they could easily monetize, as opposed to, again, that one-off property in Provo, Utah.
Yep. These are bouncing around. I just had a good one. Oh, here we go. This is a good one, and actually it's something we haven't talked about yet, but it really matters given the size that real estate became as a portion of Blackstone's pie over the past decade. But what kind of again, without being too presumptive, what kind of impact does the redemption liability have on Blackstone's stock? What would you say to investors in the stock who are hanging on because of Blackstone's dividend? I actually think this is a fascinating question.
It's a really good question. Really good question. And I think it's very material. So, again, we estimated, and this isn't it's a tough. We have to make a lot of assumptions in the fee model. Not all the money is going directly to Blackstone. There are selling fees that are shared out with partners, but we estimate a total of $2.5 billion on average going into Blackstone at current AUM levels into this fund. $2.5 billion every year. That is material. And there's BCRED as well, which has some similar issues. So it is a very material impact. I think the reputational impact is also very, very much in play here. It's any investor in Blackstone needs to be monitoring the situation.
Yep. Okay, let's see. This one's from this is from Peter. Could Blackstone provide clients of B-REIT with their funds from other Blackstone capital sources? Is that possible? I don't know.
I don't know. I wouldn't be able to say, but it's hard to imagine the mechanism to do so.
Yeah, that'd be tricky. That'd probably be. I imagine that. Well, it's like an FTX scenario.
Well,
not to
but
like.
Wait. Question.
What's that?
But question, guys. Didn't they sell these Vici? Didn't they sell these Vici assets? These assets to Vici. And again, I don't think that was. I guess that was held in B-REIT because that was part of the B-REIT class. So
yeah.
Back up. Disregard. Sorry about that.
No, it's okay. No, it's okay. It's okay. Okay, so maybe like two more. Just being respectful of your guys' time, and you guys have been awesome and so generous with it, and we and everyone really appreciate it. But this is from RW. As a multi-decade real estate professional, I'm not convinced this is leading to a crisis for Blackstone, Starwood, or the market generally. The gates are not 100% just limited. Investors are getting out, have a chance to get out at above market values for now, which will compress. That's not really a question. It's more of a comment.
I'll take a stab at it.
Wait. So then it continues. In the coming months, this is also a potential arbitrage opportunity. Sell your B-REIT or S-REIT, but buy publicly traded REITs, but we'll see. So it was a two-part. Sorry, yeah.
I want to say on the first part, obviously, if he puts his $1 million order in for December to try to get out, and they're saying that they're only going to fill 0.3%, that means he's got to go back on January 1st to redeem $997,000.
Yeah.
And then goes back in February, goes back in March. I mean, at this point, if you put your request in, you may not be out in 23.
Yeah.
You may not be out into 24. And so it's not necessarily saying that's going to cause a run. It's the fact that you just can't get out of your position as the queue grows. And I think this is our takeaway, is that investors are basically taking the gains off the table of the private REITs because all the publicly traded guys are basically trading at discounts to NAV if they see better opportunity in the publicly traded markets. And by the way, if I want to get out of my $1 million position in Simon Property Group, take a report, you're done. You sold $1 million worth of Simon just like that. If I want to get out of my $1 million of B-REIT, you're not going to be talking a year from now, 12 months to this exact day, and I may still not be out of my $1 million position.
Mm-hmm.
Yeah.
And actually,
that arbitrage opportunity is. That arbitrage opportunity is significant in our view. And we've normalized. We created, to do the valuation comparisons, we created a portfolio that mimics Blackstone using publics as best we can by geography, by subsector, by every variable we could think of. And there is a very substantial arbitrage. The problem is I don't know how you can get liquidity to enact that arbitrage on Blackstone, but if you can find a way to make that play, I agree that there is a very significant opportunity here, and that's even regardless of the doomsday scenario. So I agree with his first comment too, that said that this may not be the end of the world. They might be able to get past this. They can stem the tide of redemptions or create enough demand that they can use inflows to offset the redemption requests. Mm-hmm. Then they can wait this out and they'll probably be fine. There's no guarantee. The problem is the psychological fears that they have created, which I think they've underestimated by gating the fund in potentially creating that run on a bank. It's not, we're dealing in probabilities, not certainties here. And the probabilities and the possibilities of that run on a bank scenario have gotten much, much more real because they've gated the fund and since they've gated the fund.
Mm-hmm. Okay, so one quick one for me. Do you guys think that this is going to evolve into kind of like a rolling gating quarter by quarter? That's how I imagine it going, right? Because at this point, you can't really afford to be last in line. So everyone's going to redeem, or like a significant portion is going to redeem, and at the same time your NAV is compressing, at least theoretically, you're going to trip that 5% like every quarter, and it's just going to roll, right? I mean, am I thinking about that the right way structurally?
That's exactly how we anticipate this playing.
Yeah,
you know,
interesting.
just like, you had the crowding effect, and everything went in on the way up. It looked like one thing, and then a slow release on the way out. Blackstone trying to control, that with the gating, trying to control it so that they can buy time and sell these properties the right way and not have to panic sell. And I think that's very likely how it will end up playing out.
Got it. Okay, last one. So this is from Bill. In an illiquid market, private real estate equity, or NCREIF, underwriting refuses to mark down, hiding behind, quote, there are no market transactions to demonstrate the markdown. This represents a structural flaw in the professional appraisal industry. How will it change? Do you guys have a view on that? I guess maybe what breaks the logjam there, right?
I will say Bill's the second guy that has called out the appraisers. Mm-hmm. We've in as many days, this is the second guy that's called out the appraisers on these deals. And so, not to speak for Phil, but yes, I think the appraisers are going to be scrutinized on this after the fact, because, Rob, from where we sit, what is never a good sign is when you start staring at the tape and you start seeing all the law firms filing class action lawsuits against various REITs because of a story or whatever it is. And I'm sure the law firms would be, chomping at the bit to get inside of B-REIT and what's going on there when it comes to the appraisers, because I have a feeling that's who it's going to be going after. Phil?
Yeah, and I mean, I don't think the appraisers are I think they're great at what they do, right? The problem is that when you do an appraisal, that value sticks until you do the next appraisal. Mm-hmm. And, you're on a cycle that's just very slow. And when the market is turning as much as it did recently, when the market's moving as fast as it is, and, to the downside, those appraisals go stale very quickly. It's not the fault of the appraiser, but they do go stale. And the NAVs don't reflect it.
Yep.
I was just going to say one more thing. If I don't like what CBRE appraises my properties for, I can bring in Colliers. And if they give me a better number, guess what? CBRE, you're fired. Colliers, you're taking the position. And if I don't like what they tell me next report, because again, Blackstone's supposedly with deep coffers, they can replace these guys on the fly.
The old rating agency probably, right?
Yeah.
We're going to get the rating we want. Yeah.
I'm going to find the best guy that's going to value my properties the highest dollars.
Yeah, I know.
It's exactly what I was thinking. A scene in The Big Short where
I watched it last night.
We don't give them the rating, they'll go to Moody's.
Yeah. All right. Well, this was awesome. I'm sure I'm getting tremendous feedback in real time from folks. So it's very topical. It's very timely. Oh yeah, David, go for it. Absolutely.
I was just gonna say, if we really appreciate doing this. This is why we're doing this. If anybody has any questions, please feel free to reach out to us at Armada ETFs, www.armadaetfs.com. You can get in touch with both Phil and myself. We'd be happy to follow up with people if there are questions. As you know, I don't know how active many of your guys are on Twitter. We know that there's a big Twitter following on Hedgeye.
We dabble a little bit.
Phil is very approachable on Twitter at Phil. At PhilBach1, where we could answer these questions. So we want to make sure that we say to the people here that just because we're ending our conversation here right now doesn't mean that we're not going to continue to answer questions. Please follow up with us. ArmadaETFs.com. We run the residential REIT income ETF. The ticker is HOUSE, HAUS. Because again, we're focused on about 55 to 6% of this B-REIT portfolio when it talks about single-family residential, again, in the publicly traded market. So we think we have a good proxy for a good portion of this B-REIT portfolio.
Yep. Phil, you want to leave us with anything before we break, or?
No, that's great. Really appreciate this, and thanks for your time and for all the listeners' time.
Absolutely.
Thanks, Rob.
You guys are always welcome. Thank you very much. And thank you, everyone, for joining us. I'm pretty sure we'll have this up on YouTube for a replay. And until next time, see you soon.